Hey everyone, and welcome back to the channel where we demystify the markets and uncover unique opportunities. Today, we're diving deep into a fascinating situation that's caught our attention on the hard-to-borrow screener Global Interactive Technologies, Inc., trading under the ticker GITS. This isn't just a generic short squeeze discussion. We're going to break down GITS specifically, looking at its incredibly high cost-to-borrow fee and what that could mean. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Global Interactive Technologies, Inc., or GITS, is a company operating in the communication services sector, specifically within internet content and information. Through its subsidiary, GITS focuses on technology platforms in South Korea, notably with Fanning, a digital fan engagement platform. Think online communities, content discovery, user interaction, and much more for fan bases. With a market cap currently sitting around $7.06 million, GITS is firmly in the microcap territory. Good chart GITS. Looking at recent price action, GITS closed today down 1.89%. Over the last 5 days, it's been flat, showing 0.0% change, but zoom out to the last 30 days, and you see a significant gain of 28.40%. Volume today was remarkably low at just 18,400 shares, especially when compared to its 30-day average volume of 1,360,333 shares. This gives us a relative volume of 0x average today, meaning barely any trading activity compared to its typical. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB, and why should it be on your radar? When a short seller wants to bet against a stock, they first have to borrow shares from someone who owns them. This isn't free. The cost to borrow is the fee they pay, typically expressed as an annualized percentage of the value of the borrowed shares. Think of it like interest on a loan. The higher this fee, the more expensive and risky it is to maintain a short position. When fees climb into the hundreds or even thousands of percentages, it signals extreme scarcity of shares available to short. It can even mean that short sellers are willing to pay an incredibly high price because they have strong conviction the stock will fall even further. Why this stock is hard to borrow right now. Now let's talk about GITS. Our screener flagged GITS because its annualized cost to borrow fee is an astonishing 961.8%. Highlight CTB number that's nearly 10 times the value of the stock itself per year, just to hold a short position. While we don't have information on the momentum of this CTB fee or the exact number of shares currently available to borrow, that 961.8% tells us something profound. GITS shares are incredibly difficult and expensive to borrow right now. With an estimated float of 2.4 million shares, any significant short interest combined with this CTB could create a supply-demand imbalance. Our internal composite squeeze score for GITS is 46.0 out of 100. This score combines factors like CTB level, borrow supply, float size, and price momentum, giving us a holistic view of squeeze potential. A score of 46.0 indicates it's definitely on our radar, but not yet in the extreme high probability zone. And remember that extremely low volume today? It's something to consider: potential calm before a storm, or simply a lack of interest. Squeeze mechanics explained. For those new to the term, a short squeeze happens when the price of a stock that has a lot of short interest suddenly starts to rise. This forces short sellers, who borrowed shares hoping the price would fall, to buy back those shares to limit their losses. This buying action adds more upward pressure to the stock price, creating a domino effect as more short sellers are forced to cover, accelerating the climb. With GITS' 2.4 million share float and the insane 961.8% cost to borrow, if the stock were to gain significant positive momentum, the scramble for shares could theoretically be intense. However, it's crucial to understand, a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction that the stock's fundamentals warrant a much lower price, and they are willing to pay exorbitant fees to hold that position. Dilution risk check. One critical factor to consider when evaluating any potential short squeeze is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of outstanding shares. This typically lowers the value of existing shares and can completely negate any short squeeze thesis, even if the cost to borrow is sky high. More shares suddenly available means short sellers have more supply to cover their positions, or new shares become available to short. For GITS, we've checked recent SEC filings and found no recent dilutive SEC filings such as SMINUS 1, SMINUS 3, or 424B forms in the last 90 days. This is a positive sign for the squeeze thesis, indicating no immediate publicly disclosed plans for significant share dilution. Furthermore, we found no recent reverse split for GITS in our look-back window, which can also be a disruptive event for shareholders. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you keep an eye on with GITS? Given its current situation, the key indicators would be a sudden increase in trading volume, especially well above today's paltry 18,400 shares and ideally approaching or exceeding its 1.3 million 30-day average. We'd also look for sustained positive price momentum, reversing today's small dip. While we don't have real-time CTB momentum for GITS, a decrease in borrowable shares or a continued climb in the CTB rate would amplify the squeeze potential. Remember, its composite squeeze score of 46.0 suggests moderate, but not extreme, potential, so careful monitoring is essential. Global Interactive Technologies Inc., with its failing platform in South Korea, presents a fascinating case study in the hard-to-borrow landscape, driven by an astonishing 961.8% annualized cost-to-borrow fee. While the current low volume and moderate squeeze score warrant caution, the underlying scarcity reflected in that CTB is certainly something worth watching. As always, this information is for educational purposes only. Do your own thorough research, understand the risks, and make informed decisions. If you found this deep dive into GITS helpful, please hit that like button, subscribe for more unique market insights, and let us know in the comments what other hard-to-borrow stocks you're watching. We love hearing from you.